I
And
think stocks will not have a high return, but I think gold and other precious metals are not cheap as they were, say, in 1999 when gold was at $253. But compared to the monetary expansion that we had in the world, to the increase in wealth, to the increase in assets under management of the fund management industry, you look at fund managers, most of them have not even 1% of their assets in gold, not even 1%. And I'm suggesting people should have 25% in gold or more.
Gold has continued to see strong performance into 2025, maintaining the positive trend that began in 2024. The asset has benefited from a combination of factors, including the bull market in U.S. equities, which has helped support its price. At the start of 2024, gold was priced at $2,046 per ounce, and by January 1, 2025, it had risen to $2,622, marking an impressive 28% increase. This surge is noteworthy compared to the S&P 500, which climbed 25% in the same period, with gold outpacing it by 3%. This performance strongly indicates gold's appeal as a reliable investment, particularly amid the broader economic uncertainty. Marc Faber, a financial analyst, has raised concerns about the U.S. economy, suggesting that it may already be in or approaching a recession, even though official data such as GDP growth do not reflect this. Despite government reports showing growth, many individuals feel the effects of declining living standards. Faber notes that inflation could continue to rise even during a recession due to persistent government spending policies, which may exacerbate inflationary pressures. These factors contribute to an environment where gold remains an attractive asset, particularly as a hedge against economic instability. Another key factor contributing to gold's potential for further growth is the Federal Reserve's expected policy shift toward lower interest rates. This shift could weaken the U.S. dollar, creating favorable conditions for gold, which tends to perform well when the dollar depreciates. As interest rates decrease, gold becomes more appealing since it does not offer yield like other interest-bearing assets. Additionally, central banks, particularly in emerging markets, have been increasing their gold reserves, and further monetary easing from the Fed may encourage additional purchases. We present the clips of Faber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I expect a recession. I think we are already in recession now, but through government statistics, the recession is essentially kept off the public's attention. In other words, the standards of living of most people are going down, but the government shows, as you say, 2.8% GDP growth or whatnot. But I feel that one day the recessionary trend will become more obvious. And at that time, I suppose that interest rates on the 10-year treasuries and on the 30s will rally somewhat. In a recessionary environment, I would expect inflation to decelerate. But then we have monetary policy and fiscal policy that are highly inflationary, especially fiscal policies. And so it is possible that even if the US went into recession, at the same time, we would have accelerating inflation. That is a possibility. And I wouldn't dismiss that possibility entirely. So exactly how interest rates will move, I don't know, based on inflation figures. But my suspicion is everybody and his brother-in-law are selling bonds. In other words, they invest in stocks, but they avoid bonds. And I think there's a case to be made that, say, for 3 months or 6 months, bonds could outperform stocks. Also, Paul Tudor Jones, in his interview, he said it's sort of, he didn't spell it out very clearly, but the essence was avoid being long bonds, be short bonds. The Wall Street is heavily short bonds, heavily. But on the other hand, the commercials, who are usually well informed, they're long bonds. And I would rather bet with the commercials, in other words, with the people who are very close to the market, the hedgers. I want to address two issues that you mentioned. What is interesting is that over the last 6 months, the Fed cut short-term rates by 100 basis points, but bond yields have gone up 100 basis points. So it would indicate to me that whereas the Fed may control short-term rates, they've sort of lost control of long-term rates. I'm saying sort of, because obviously if they cut short-term rates to zero, I suppose that the bond market would rally somewhat, or they could introduce negative interest rates on short-term deposits. But to the anticipation of the dollar, I shouldn't say this, but I think the dollar is grossly overpriced, grossly. But you understand, in a money printing environment, it's very difficult to have a view on fundamentals, because what you can have is, I wrote about this recently, the housing market basically in some areas in America is back to the level in 2018, 2019. But the housing ETF is up very substantially. So we're dealing with, in a money printing environment, with essentially a money economy, and at the same time, the real economy, that what is going on between people when they transact, they buy and sell the house, or they rent something, or they sell something at Home Depot, or buy something at Home Depot. That is the real economy. But the artificial economy is driven largely from the money printing and the fiscal deficits. And these are two different things. So you have a mispricing and a misallocation of resources. But as I said, I think the economy is far weaker than what the government is publishing. Look, as I explained, in a normal environment, I would say deposits, although not a high return and probably a negative return in real terms, inflation-adjusted returns. But it's maybe better to lose 1-2% inflation-adjusted than to lose 20%. But the problem that I see with deposits is that in a financial crisis, the banks may be under pressure and deposits may not be worth very much. We've experienced that repeatedly in history. So you may be better off in some stocks. They may decline 50%, but you still have the company. Now, people have been talking about the re-ratings for years. In my view, we could have a re-rating on the downside. In other words, today a stock sells at 20 times earnings. Maybe in future it will only sell at 5 times earnings. Could be. I think stocks will not have a high return, but I think gold and other precious metals are not cheap as they were, say, in 1999 when gold was at $253. But compared to the monetary expansion that we had in the world, to the increase in wealth, to the increase in assets under management of the fund management industry. You look at fund managers, most of them have not even 1% of their assets in gold, not even 1%. And I'm suggesting people should have 25% in gold or more. And then, as I said, at the moment, the mood about bonds is everybody's negative. But in a recession, bonds could rally somewhat, maybe not as much as in other recessionary times, but they could rally because A, they are oversold, the short position is very high, and secondly, because the recession could remove temporary inflationary pressures.
Marc, as we wrap up,
then I would say real estate, the real estate market in some areas is very expensive in the US, but there are villages in Europe which are very cheap.
Marc Faber points out that the U.S. federal debt has skyrocketed to over $36 trillion, surpassing the size of the entire economy. Over the past 40 years, there have been some brief attempts to cut the deficit, but the tendency to overspend, supported by both political parties, has dominated. Surprisingly, the US has not paid a heavy price for this borrowing. Mortgage rates are much lower than in the 1980s, and inflation is more controlled. However, despite government reports claiming growth, most Americans struggle with living costs rising faster than their wages. This suggests that the reported economic growth is mainly artificial, driven by government borrowing and debt. As the federal debt has ballooned, the interest payments on that debt have increased, taking away money from other critical areas. Faber also compares the US situation to Japan's, where the debt-to-GDP ratio is well over 200%. While Japan has managed to handle its debt, it has caused problems, including a weaker yen, which has reduced the purchasing power of its citizens. Many Japanese households are struggling as wages aren't keeping up with inflation, and the currency decline has made life more expensive. Faber warns that if the US continues to pile on debt without addressing the problem, it could face similar issues, with people's purchasing power diminishing over time despite what official economic reports might suggest.
We need to make adjustments to the figures that are published by governments, because if the government says the economy grew at 2 to 3% per annum, okay, but if you adjust economic growth for the true price increases within the system, not the CPI figures that are compiled by government agencies that understate the rate of inflation. So if you adjust this by the true rate of inflation, probably there was no growth, or actually, for most people, negative growth, because the price increases exceeded the salary increases. Number two, I looked the other day at the debt level in America in 1980, because I started to work in 1970 on Wall Street. And as you know, by 1980, 81, government bonds started to rally, because during the 70s, interest rates had gone up. And the rally in bonds then created a rally in stocks beginning in August 1982. So we have a major turning point from poorly performing financial assets throughout the 70s to improved financial performance going forward from 1982 onwards with stocks, and 81 for bonds. Now, the debt level, federal debt level, was less than $1 trillion in 1980. Now we are 36 trillion. So you understand when you say the economy grew by, say, 3% and government debt grows by 5% or 3%, then the growth that you are saying is not truly real. It's a kind of artificial growth that is due to increased government borrowings. And this increased government borrowings will over time lead to increased interest payments on the government debt. And then the budget cannot anymore be balanced, because most of the expenditures become interest payments on the government debt, and there is less money for other things and so forth. So you understand? I think that when people look at GDP, they have to be very careful and analyze what caused growth. Was it just price increases, or government debt increases, or credit in general, private credit growth, and so forth? And in my opinion, there maybe have been nominal growth of 2 to 3%, but in real terms, 70% of US households are worse off than a few years ago. They haven't recovered to the 2018 level or earlier level. The currency has weakened very considerably, so the purchasing power of households has been declining. And the Japanese claim they have very little inflation. But I can assure you, I've been going to Japan for the last more than 50 years, and Japan is always an expensive country. Now, there are times when it's relatively cheap, and there are deals, you can have a holiday, skiing holiday in a package, relatively reasonable price. But otherwise, the country, say if I measure how much it costs you to travel from the airport to the city, then in Tokyo, if you take a taxi, it will set you back almost $200. So, in Singapore, I can go from any place to the airport for, say, 25 US dollar. Hong Kong, a little bit more, maybe $30 US. So I'm just saying, the Japanese in recent times, in other words, in the last, say, 2 years, the population has lost considerable purchasing power because of the weakness in the yen. And most people in Japan get paid in yen, and salaries haven't gone up that much.
And so once again, you're expressing concern about the U.S. economy. You don't think the U.S. economy is as strong as we're told it is?
This is what I think, that the economy, and I see that myself, because A, I'm an economist and a social observer, but two, I'm a wealthy investor, okay? So as a wealthy investor, I pray that the Fed will continue to print money, and that as a result of this money printing, asset prices stay high or move higher. In other words, I, as an asset holder, I don't want assets to depreciate. But as a social observer, I can tell you that the majority in a population, whether it's in Asia or in the US or Europe, the majority is not progressing at all, because whatever wage gains they have, and these wage gains are not huge, they lose out on increased cost of living expenditures. And the Fed relies on the Bureau of Labor Statistics, and the Bureau of Labor Statistics publishes lies. According to the BLS, the Bureau of Labor Statistics, healthcare costs have been down over the last 3 years. I don't know any insurance company in the whole world that has lowered its premiums over the last 3 years, which is an indication of healthcare costs. Number two, most prices of pharmaceutical products are not going down but up. It may be true that some drugs that come off patents then decline in price, but by and large, send your children once or your parents to hospital. You will wake up how much a hospital costs. That I can assure you. So I question the statistics that the government publishes, as I question everything else governments do.
Experts predict that gold prices will continue to rise in 2025, driven by strong demand and positive economic factors. Central banks, especially in emerging markets, are expected to keep buying large amounts of gold, which will help maintain higher prices. In addition, there is likely to be a surge in investments in exchange-traded funds, ETFs, which could further support gold's upward movement. With central banks, particularly the U.S. Federal Reserve, expected to lower interest rates, gold becomes a more attractive option, as it doesn't rely on yields like other investments. As a result, gold prices could hit new highs, reaching $2,900 per ounce by early 2025, and may even approach $3,000 per ounce in the long run, driven by substantial central bank purchases and increasing investor demand. Share your thoughts on Marc in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.